Every trader knows what it feels like to lose. That sting when the stop loss hits. The doubt that creeps in. The temptation to change everything. Strategy, mindset, even belief. But what if the difference between losing and winning wasn't about the market at all? What if it came down to one forgotten rule? A principle so old, so fundamental, that the world's best traders still swear by it, even as most retail traders have completely forgotten it. This is that rule, the one that quietly turns losses into profits. Let's start with a truth that almost no one wants to hear. Winning trades don't make you profitable. Good risk management does. But this isn't another risk 1%, reward 3% cliche. The rule goes much deeper. It's about understanding how losses compound. See, most traders think in single outcomes, one trade at a time. But professionals think in distributions. They know that trading is a game of probability, not prediction. And once you accept that, the question shifts from, how do I win this trade? To, how do I survive 100 trades? That shift from outcome to process is the forgotten rule. Because losses, handled correctly, don't destroy your capital. They build your edge. Take this example. Two traders, both equally skilled. Trader A risks 10% per trade. Trader B risks 1%. After 5 losing trades, Trader A is down nearly 50%. Trader B, just 5%. One is fighting to survive. The other still has ammunition. Same strategy, different outcome. That's not chance, that's math. It's called geometric compounding. The invisible enemy of overleverage. Once you lose 50% of your capital, you need a 100% gain just to break even. Lose 80%, and you need 400%. That's why pros obsess over preservation. They don't avoid risk, they manage it with surgical precision. This is the rule the greats live by. Protect your capital at all costs. It sounds simple, but it's the dividing line between traders who last and traders who vanish. Jesse Livermore learned it the hard way, making millions, losing it all, and making it back again. George Soros built his empire not by winning every trade, but by cutting losers instantly and pressing winners. Paul Tudor Jones once said it best. Don't focus on making money. Focus on protecting what you have. That mindset flips everything. Losses stop feeling like failures and start becoming data points. Feedback loops that refine your edge. And here's the twist. Once you stop fearing losses, you trade better. Your emotions stabilize. You stop revenge trading, stop chasing, stop overleveraging. Your discipline improves because you finally understand. That risk is not your enemy. It's your cost of doing business. Every losing trade becomes tuition. A small, controlled payment toward mastery. That's why pros don't measure success in wins. They measure it in consistency. They ask, did I follow my plan? Did I size correctly? Did I control my downside? If the answer is yes, they've already won, even if the trade lost. Because in the long run, the math catches up. Probabilities converge. And those small, disciplined losses become the foundation of exponential profit. The forgotten rule, then, isn't a technique or indicator. It's a principle. Always think in series, not singles. Don't judge your success by one outcome. Judge it by 100 disciplined repetitions. That's where the edge lives. Not in luck, not in prediction, but in process. And here's where it gets interesting. When you apply that mindset, something shifts inside you. The fear of being wrong dissolves. You stop trying to be right and start trying to execute right. And that's when profits start appearing. Not because the market changed, but because you did. This is why so many traders plow. They chase strategies but ignore structure. They backtest entries but never test position sizing. They want holy grails, when the real holy grail is discipline under probability. Every professional fund, from hedge funds to prop desks, operates under one obsession: risk-adjusted return. They don't just look at P&L. They look at volatility, drawdown, Sharpe ratio, because profitability without control is gambling dressed as trading. So how do you apply the forgotten rule today? Step 1. Set your maximum risk per trade, not based on what feels safe, but what keeps you in the game. For most traders, that's 1 to 2%. Step 2. Track your drawdowns. The moment you hit a 10% loss streak, cut position size by half. That's not weakness, that's survival protocol. Step 3. Review not just your winners, but your losers. Ask what went wrong before you try to fix it with another trade. And step 4. Accept variance. Even perfect execution will have losing streaks. The pros expect it. The amateurs panic. When you internalize this, losses stop hurting. They become just another step toward long-term compounding. You're no longer reacting to the market. You're managing your exposure to it. That's the mindset shift that transforms trading from chaos to craft. The forgotten rule that turns losses into profits isn't about being fearless. It's about being consistent. It's about realizing that the outcome of one trade means nothing compared to the next 1,000. Because mastery in trading is not about control. It's about discipline under uncertainty. The markets reward those who can lose gracefully, adapt intelligently, and compound patiently. The traders who remember that rule end up outlasting everyone else. And in the end, survival is the ultimate edge. If you found this insight powerful, hit that like button. Share it with traders who need to hear this today. Drop your thoughts below and subscribe for more deep, data-backed insights into how real traders think, act, and win. Because your next breakthrough might not come from a new indicator, but from remembering the rule you forgot.